Stock futures drop as traders assess the US presidential debate and brace for inflation data. Saudi Arabia's Vision 2030 surpasses tourism targets early as non-oil GDP rises. And the battle of the smartphones. China's Huawei launches its rival to Apple's iPhone. Hello, I'm Taiba Aiden with the latest business and finance news here on TRT World. US stock futures dipped overnight as investors eagerly await the August inflation report and assess the implications of the recent US presidential debate. With inflation data due to be released, markets are anticipating how the Federal Reserve might adjust interest rates in the coming weeks. Stock futures fell following the Trump versus Harris presidential debate overnight. Dow futures fell by 0.3%, while the S&P 500 and Nasdaq futures dropped 0.32 and 0.36% respectively. Investors have now turned their focus to August's US consumer inflation report, which will determine interest rate predictions. Meanwhile, meme stock GameStop announced a sale agreement for 20 million additional shares. The stock dropped significantly after hours, affecting overall market sentiment. August's CPI is expected to rise by 0.2% from July, with annual growth estimated at 2.6%. The Consumer Price Index and Producer Price Index will heavily weigh on the Federal Reserve's next rate cut decision. During Tuesday's regular trading, Nvidia, Tesla and Amazon bolstered the Nasdaq by 1%, while the Dow Jones fell by 0.2%, dragged by JP Morgan's performance. Let's get more on this now with Chris Weston. He's head of research at Pepperstone. Good to see you, Chris. Now, how much influence do you think the presidential debate has had on market reactions?
It's been a little bit of a reaction coming through. So clearly, if you look at the prediction markets, the betting markets, you've seen a bit of a rise in Harris's probability of getting the White House. She probably rose about 3 percentage points. It does seem that she did seem quite presidential. She sort of put Trump off balance. But you've seen probably a bit of an unwind of the Trump trades. We've seen a little bit of US dollar selling. Crude's had a bit of a rally. We've seen crypto, Bitcoin under a bit of pressure. And we haven't really seen it. We've seen a bit of buying coming through in the Treasury market today. And despite Kamala Harris talking about fiscal expansion policies, I think the market's got to the decision that she's not going to be able to pass any of those measures because the Republicans are going to get the Senate. So, a little bit of selling, probably mostly on the Trump side, or the Trump trades being unwound a little bit because Kamala Harris's probabilities increased a bit there today.
Right, and now we have CPI data also coming out later in the day. How critical will August's inflation report be in determining the Fed's next rate policy?
Well, I don't think it's going to be as critical and market impactful as we've been seeing in some CPIs because, the Fed have recalibrated their focus towards the labour market so substantially now that, they basically told us that their war on inflation is over and that they've got strong confidence that it will gravitate lower. So, I think we're going to need to see a pretty big miss to consensus or beat consensus to get the market moving. The market is expecting headline inflation to drop to 2.6%. We're going to see about 70 basis points coming off from lower energy prices. But it's the core number, I think, which people are going to look at most closely, and that's expected to be unchanged. So we're looking very closely at things like rents, owners equivalent rents, and those factors in there because services inflation is going to still be quite sticky. I think we'd need to see a number well below 3% year on year to get that 50 basis point cut firmly on the table. But as it stands at the moment, we've got 32 basis points of cuts being implied into the rates market, which gives you about a 28% chance for 50 basis point cut. So, I think we'll have to see a pretty substantial beat or miss to that consensus to get the market pumping along.
Right, now, stock markets have been on a roller coaster ride this year. What impact could Trump's proposed tariffs on China have on the tech and manufacturing sectors?
Oh, it'd be huge, absolutely massive, but it probably won't happen. Trump has talked about 60% tariff on Chinese imports and 10% on a broad basis. But he's obviously a property mogul, and I think he comes in with his hardest gambit, and then we'll pare it back, just like we saw in 2020 with NAFTA, when he promised to sort of move away from that, and the reality was very different. So I think he's obviously threatening and talking a good game. But I think 60% tariffs on Chinese imports, which obviously sort of play into the manufacturing space, would really, really impact the Chinese economy to such an extent that there would be a negative feedback loop into the US. So I think the reality is that he's talking a lot of bravado, a lot of hot air. The reality of tariffs, if he does become president, will be markedly different from what he's claiming at the moment.
All right, Chris Weston, we'll have to leave it there. Thank you very much for your insight.
My pleasure. Thank you.
Now a quick look at some of the other leading business stories from around the world. Oil prices has resumed its downward trend on Tuesday, falling more than 3% after OPEC reduced its demand forecast for the second time in 2 months. Crude oil futures hit their lowest level since December 2021 as the market sell-off intensified. West Texas Intermediate fell about 4% to $65.75 per barrel, and Brent dropped more than 3% to $69.19. The Nikkei 225 declined for the 7th consecutive day, extending losses from the previous session following hawkish statements from a Bank of Japan policymaker. The index fell 1.5%, while the broader topics dropped almost 2%. Declines were led by pharmaceutical, marine transportation and precision instrument stocks on the prime market. European businesses say China must act to improve the business environment. Companies said growth in China has slowed and they are tired of waiting for changes. Foreign investment in China has fallen nearly 30% this year. European leaders say now is the time for China to take action if it wants more investment. And Amazon Web Services will invest more than $10 billion in UK data centres over the next 5 years. It's expected to help Amazon better compete with Microsoft and Google in the region. The investment comes as businesses explore generative AI growth and productivity. Amazon Web Services and other cloud companies are investing in AI infrastructure to support global competition. It also plans to invest in cloud infrastructure in Germany. Still to come, Kenyan aviation workers embark on a strike, causing delays at Nairobi's main airport. That and more after this short break.
Intuitive, inclusive, informative. From the remotest reaches to the teeming metropolises, the world is one click away. TRTworld.com.
I'm Enda Brady, and I've been asking questions all my journalistic life. On Roundtable, I ask the questions you want the answers to. The big issues, the main talking points, and the best experts. What you need to know now. Roundtable on TRT World.
Chinese smartphone maker Huawei unveiled its latest model, the Mate X-T, on Tuesday, just hours after Apple unveiled its latest iPhone. Huawei is seeking a return to the smartphone market following years of US sanctions. Apple's highly anticipated iPhone 16 features its first ever generative AI software, and a feature the company hopes will help convince customers to upgrade. The price of the phone starts at $799 and $1,199 for the Pro models. Huawei's tri-fold smartphone, which it claims is the first in the world, retails for double that at around $2,800. Huawei's Mate X-T also comes with artificial intelligence features such as text translation and cloud-based content generation. It has already received more than 4 million pre-orders. The Chinese company has sought to make a comeback in the smartphone industry, which was hit hard after the US slapped sanctions on the company in 2019. Its recovery is a direct challenge to Apple's performance in China, its second largest market, accounting for around 20% of shipments. Apple fell out of the list of top 5 smartphone vendors in China in the second quarter, according to Canalys, making it the first time that domestic players held all 5 spots. Both smartphones are set to go on sale September 20th. Let's get more on this now with Dennis-Kenji Kipker. He's Research Director at Cyber Intelligence Institute. Good to have you back on the program, Dennis. Now, there's increasing competition for Apple in China at the moment. How is it going to overcome these challenges?
Yeah, so in recent years, Apple has rested too heavily on its Western market position, that's quite clear, which was based on the fact that it was a global market leader in smartphones for decades. But this situation has changed, and Apple seems to have grown tired of bringing out innovation with every product announcement. And this has led to increasing competition in the global computer and smartphone market. And one of these companies is definitely Huawei, which has invested a lot of money in development capacities in recent years. And however, stricter regulatory requirements are also making it increasingly difficult for Apple to do business in China. This applies, for example, to the new AI assistant, which cannot be offered until 2025 due to some testing approvals from the Chinese authorities, contrary to the advertising announcements of Apple.
Right, and Huawei has also included this generative AI. Competing with Apple, but the phones are not much cheaper than the iPhone. So why are Chinese consumers opting for this domestic brand?
Yeah, that's really a good question. So especially with high-priced smartphones, including Apple, it is not so much the price alone that is important for the success of a product, but the user experience. So people are quite prepared to invest over $1,000 up to $2,000 for a new smartphone, but they want to see visible innovation in return. And Huawei has delivered this with its new foldable top-of-the-edge smartphone, which can be adjusted to tablet size. And the largest possible displays are always popular in China. And China is also explicitly promoting buying regionally from Chinese companies. And this is a trend that we're also seeing in Western countries. So where digitalization automatically went hand in hand with globalization for many years, the focus is now back on regionalization of IT systems, and this also includes smartphones.
Right, and what kind of challenges is Huawei facing now in its recent comeback?
Yeah, the problem is here mostly the semiconductor supply chain. So the Chinese state, as well as Huawei, they both have received a lot of supply chain sanctions in the past. But Huawei, it is to say, has performed quite well in recent years. So after the US sanctions and the European supply freezes for semiconductor manufacturing machines came up, they were initially concerned that Huawei would not be able to keep up. But last year, Huawei itself presented a Chinese-made 7-nanometer chip in a smartphone for the first time. And the same applies to the software. After Huawei was excluded from Android operating system, it presented several years later its own operating system. And this path is probably not yet complete, especially in view of the developments of artificial intelligence from China. And that is a problem with economic sanctions. And the US in particular have misjudged their effectiveness here.
All right, Dennis-Kenji Kipker, we'll have to leave it there. Thank you very much for joining us.
You're welcome.
Sony has announced the PlayStation 5 Pro launching on November 7th for $700, featuring significant upgrades in graphics and performance. This comes as Sony faces a decline in PS5 console sales, with 2.4 million units sold in the first quarter, down from 3.3 million the previous year. The PS5 Pro includes advanced ray tracing, a 2 TB solid-state drive, and enhanced AI for sharper visuals. Several popular games will have special features for the new console. Now, strike action by the Kenya Aviation Workers Union at Nairobi's Jomo Kenyatta International Airport has caused flight delays and cancellations. The Go Slow protests a proposed deal allowing India's Adani Group to lease the airport for 30 years, fearing job losses and foreign workers. Kenya Airways confirmed that both arriving and departing flights were impacted. The government insists the airport needs modernisation but is not for sale. Grace Courier-Kanja has more on the background of the strike.
Adani Airport Holdings seeks a $1.85 billion investment deal to upgrade and run the airport for the next 30 years, during which it expects to get 18% of the project's annual returns. It promises that the upgrade will almost double the airport's revenues by 2030. Now, the deal would see Adani, which controls big chunks of India's infrastructure and is developing a greenfield airport in Mumbai, add a second runway at Nairobi's main airport, upgrade the passenger terminal and give JKA technology and logistics upgrades. It says this would provide local employment opportunities. But according to Adani's feasibility study, it would also have the right to employ non-Kenyan skilled expatriates. The Kenya Aviation Workers Union accuses the government of selling off the main airport and also says Adani intends to lay off the majority of employees. They want the deal abandoned in its entirety. So do Kenyans whose planned protests at the airport were thwarted by the government a few weeks ago.
I have seen many people saying William Ruto wants to sell the airport. Am I a madman? You know, sure, how do you sell a strategic national asset? You have to be insane. We want to work with the private sector for them to do three things that are critical for our airport.
Now, the strike could cause major disruptions at one of Africa's top air cargo traffic airports and region hub that has a capacity of 7.5 million passengers a year.
Joining us now from Nairobi is Ken Gichinga. He's Chief Economist at Mentoria Economics. Good to have you on the programme, Ken. Now, how significant is this disruption caused by the airport strike?
Many thanks, Taib. Indeed, these are very dramatic scenes at the airport as police exchange with the local airport officials. Obviously, Jomo Kenyatta is the largest airport in the country, the seventh busiest in the continent. So obviously, this will be a huge disruption to the exporters who have to export produce to Europe, to Asia, as well as for tourists who are coming in and the countless numbers of business people who travel every day.
Right, and what are the key concerns regarding the proposed deal with Adani Group?
Well, I think it's the lack of full disclosure around it. This matter only came to the public domain in the last few weeks. And I think there's been a sense that the confidentiality has meant that the workers, employees at the airport are not confident whether they will be able to keep their jobs at a time when unemployment in the country is very high. Part of that feasibility study that Grace mentioned in that interview is the opportunity for Adani to also hire non-Kenyans at the airport. That is also contributing to a significant level of anxiety.
And how does the government plan to balance modernization and job security at the airport?
Yeah, that's the million-dollar question. The airport does need to be expanded. If you look at the neighboring countries, Ethiopia, Rwanda, there is significant investment. But also, this is at a time when the coffers are not where they need to be. The fiscal situation of the country cannot support a $2 billion expansion. So these are the solutions that are being proposed, and one of them has been forwarded by this particular group.
All right, Ken Gichinga in Nairobi there. Thank you very much for your time.
Many thanks.
Former European Central Bank Chief Mario Draghi is calling for the reduction of regulatory oversight on European companies to help businesses become more competitive and innovative. Draghi also stressed the need for greater investment in the EU, hundreds of billions of dollars, to compete with other leading economies, as Emre Boz reports.
The handover is complete. A year in the making and hidden in this report requested by the European Commission is a call to transform the future of the European Union's policies. Put together by former Italian Prime Minister Mario Draghi, the report outlines two key goals: a shift to green investments and the need for greater competitiveness.
The only way to ensure our long-term competitiveness is to shift away from fossil fuels and towards a clean, competitive and circular economy. The second principle, our efforts on competitiveness must go hand in hand with increased prosperity for everyone in Europe.
And one way Draghi says the EU will ensure this is through reducing regulatory burdens on European companies. It means supporting a cut to financial reporting requirements for small and medium-sized enterprises. Draghi also demanded a new industrial strategy for Europe. This involves raising investments by more than $880 billion a year. He believes this will stop the Union from falling behind the US and China.
Now conditions have changed. World trade is slowing. China is actually slowing very much, but it's become much less open to us, and actually it's competing with us in global markets on all accounts. We've lost our main supplier of cheap energy, Russia, and now we have to start for our defense again for the first time since the Second World War.
The EU's economic growth has been struggling since 2023, hitting no growth for 2 quarters within that period. Analysts say that the EU's raising of interest rates since June 2022 to a peak of 4.5%, the highest since 2007, played a role in stifling domestic demand by making borrowing costs much higher. And this has impacted the EU's growth rate. Some experts say the removal of red tape may be what's needed to spur innovation. Others, however, are critical, citing the global financial crisis of 2007 as an example of deregulation going wrong, where a lack of financial regulatory oversight led to riskier practices in mortgage lending go unchecked. But desperate times call for desperate measures, and with the EU under pressure to compete, it will be a game of wait and see if such strategies pull through. Emre Boz, TRT World.
Saudi Arabia's ambitious Vision 2030 is beginning to pay off, with non-oil sectors experiencing notable growth. And it's already 7 years ahead of plans on its tourism target of attracting 100 million visitors.
Saudi Arabia is working to break free from its reliance on oil. In 2016, the kingdom launched Vision 2030, a bold initiative to diversify its economy. Now, that vision is starting to bear fruit. Non-oil economic growth surged to 4.9% in the second quarter, exceeding expectations and marking the strongest performance in a year. The financial, business services, and insurance sectors saw significant growth, expanding by 7.1%. Other major contributors to the economy include government activities, wholesale, and retail trade. But these achievements did not stop the kingdom from suffering a decline in real GDP. That was mainly due to an 8.9% drop in oil activities following a decision to cut production in line with OPEC Plus agreements. The production cut has been extended until December 2024. The oil sector does not create enough jobs for Saudi Arabia's young and increasingly educated population. To address this, the government has rolled out incentives to bolster both the services and manufacturing sectors. $1.3 trillion has been invested in real estate and infrastructure over the past 8 years to diversify the economy and boost its domestic and international appeal. And now, in a remarkable achievement, Saudi Arabia has already surpassed the goal set back in 2016 of 100 million tourists by 2030, way ahead of schedule. And while crude oil and natural gas still contribute the most to the country's GDP, the kingdom sees light at the end of the tunnel, as its non-oil economy continues to strengthen.
In the busy streets of Karachi, a silent revolution is taking place. Women, once confined to their homes, are now riding through the economic storm, stepping into the workforce to support their families. Their presence in the bustling business hub is a sign of changing times. Malik Fouda has the story.
Amina Sohail weaves through Karachi's traffic on her motorbike, catching glances from pedestrians and drivers alike. For her, it's more than just a job. It's a statement. She's the first woman in her family to work, and she's proud of it.
My vision has changed. My thoughts are unlimited. I'm confident, and I will work openly like any man, no matter what anyone thinks.
In Pakistan, inflation has risen sharply. More women are finding themselves outside of the homes, working to support the family. The cost of basic items like tomatoes has jumped by 100%. While electricity and gas bills have skyrocketed by 300% in just 1 year. These challenges have forced families to seek new sources of income.
It's because of my accident that my wife had to get a job. But this is nothing to be sad about. I stand with her. We are companions, and we are running the house together.
In Pakistan, many women need their family's permission to work. The UN reported just 21% of women in Pakistan are part of the workforce. And many of them work informally, especially in rural areas. But the large port city of Karachi, home to millions, is leading the charge for social change, and its bustling streets are reflecting the shift.
The atmosphere in the house was stressful due to the economic crisis. My parents were stressed and couldn't manage the house. That's when I thought I must work.
As more women take up jobs, they're proven they're just as capable as men. They're contributing to their families and the country's economy. And while social norms and safety concerns still pose challenges, these women are riding through those barriers. Malik Fouda, TRT World.
Well, that's all your business news for now. Thanks for watching.
From Wall Street to Main Street and the people in power. Money talks, and so do we. The world of business and finance isn't just about dollars and cents. We meet the people behind the numbers and examine how it affects you. With reporters and experts around the world, we'll cut through the jargon and bring you the news that matters. Money Talks on TRT World.